Today I wanted to come across one of the most common questions that we get here at our office, and it's mortgage insurance. So what is mortgage insurance? Well, there's a couple different things you're going to hear throughout on a mortgage insurance. First of all, there is a mortgage insurance that means you don't have enough basically equity in the home. It's called PMI or mortgage insurance. That's for the mortgage company to protect itself in case there was an issue with your mortgage or total loss or whatever it may be. But that's to cover the mortgage company. That has no benefit for you at all. It's just an extra charge by the mortgage company because you're not at a, let's say, 80% loan to value, which means your mortgage is more than, let's say you bought the house for 400,000 and it's worth 400,000, your loan's 400,000, you would be at what's called a 100% loan to value when the banks or mortgage companies want you to be at 80. That's going to be the first one. That's mortgage insurance for the mortgage company. The other couple that you're going to see quite a bit is mortgage insurance, maybe that you get from another company if you did a refinance or a purchase. Basically, showing a very low monthly amount or yearly amount that will actually pay your mortgage off. If you really look at the fine print of that, that is going to be accidental or dismemberment. Very rare when something like that does happen. That's why it's such a low amount to get your mortgage covered if something were to happen to you, let's say in a plane accident, car accident, whatever it may be. The true mortgage insurance is if something happened, if you passed away from anything, which is technically going to be a life insurance policy. So they call it mortgage insurance because that's one of the things you can cover to pay off. So for example, if you have a $400,000 mortgage and you wanted to pay off the mortgage in case something happened to you and leave it to your kids, your spouse, you can do that. It's basically going to be a check to do with as whatever they want to do. Now, you can have a directive to pay the mortgage off. That way there is no more mortgage on the house in case something happened to you. But a life insurance policy or a mortgage insurance is going to be basically a death benefit paid to whoever as you have as your beneficiary or beneficiaries. So that's the true definition of a mortgage, where in case anything happened, whether you got sick, COVID, whatever it may be, it doesn't have to be an accident. It can be, a long-term illness that ends up taking your life or whatever it may be. That's going to give you true mortgage protection, which is, for example, if you had a $400,000 mortgage and you wanted to make sure that was paid, you would want a death benefit of $400,000. Now, there's a lot of different ways to get to that amount. So you can get a term policy for 10, 20, 30 years, which is going to be your least expensive. So those are only going to pay out when you pass. You could get a whole policy that'll last, the premiums are set for your entire life. You could get an index universal policy that's going to actually have a lot of investment with that, as well as the death benefit. And there's always other options as well to pay that mortgage off. Now, let's say you had that $400,000 mortgage, you took out $400,000. If you did pass away and you didn't have a directive, they can use that how they would like, your spouse or your family or loved ones. But at least there's enough money to pay off the mortgage. So let's say you can't afford the premiums that are $400,000, for example, on that same scenario. Maybe you want to cover half the mortgage, which would be $200,000. Maybe you want college educations. Maybe you want to, just enough. Maybe you only have enough for burial expenses. Whatever it may be, some is obviously going to be better than none. Even if you don't have a lot of loved ones around, somebody's probably going to either have to cremate you or bury you. So wouldn't you rather take care of the financial obligation ahead of time to make sure they don't have to come up with the money to do that? Because a lot of times if money's tight, what do you do if you have to cremate somebody or bury somebody and you don't have the money to do it? But the true definition of mortgage insurance is life insurance. It's just another term for it. And to be honestly, because most people don't like talking about when they pass away, it's not a popular subject. I will tell you this, though. It is the only policy that I have that has a guaranteed payout at some point if you get a whole policy. We're all going to pass away. So making sure that we can take care of our family, loved one, spouse, whoever it may be that we want to take care of, that leaves that up. That takes care of them financially after the fact. It's hard enough going through a loss, but then have to deal with the financial ramifications of it can be even more difficult. So I wanted to thank you for joining me on this episode of During Insurance Right, talking about mortgage insurance. As always, if you could rate, review, or subscribe to whatever fantastic platform you're listening to us on, whether it be Spotify, Apple, Google, or any of the fantastic ones out there, I'd appreciate it. And I look forward to seeing you on the next episode.